A golden cross is one of the more important chart patterns for market watchers. Here we take a closer look at how it can be used to spot market trend changes. First, what is a golden cross? Well, the key to understanding them is to get to grips with moving averages, measures that help to determine the direction of a current trend. A golden cross is the pattern that appears on a chart when a short-term moving average, which reflects recent prices, rises above a long-term moving average, which reflects the longer-term trend. This technical pattern is indicative of the likelihood for prices to take a bullish turn. Even more so if the cross is accompanied by high trading volumes. The idea is to use the golden cross as an indicator to recognize the change into an uptrend and to trade this move. There are three stages to the golden cross. Before the cross is formed, there's a downtrend in price movement. Then a new trend emerges whereby the short-term moving average takes over the long-term moving average. This is the intersection. Finally, there must be a continuation of the uptrend, and the short-term moving average must act as a support level for any pullbacks in price. So how can you trade when you see a golden cross on a chart? Typically, you would enter a trade when you've confirmed the bullish trend, so if you think the asset's price will continue to rise, you'll open a long position. Once the short-term moving average starts dipping below the long-term moving average again, you may want to exit the trade. Remember that you need a solid trading plan and risk management strategy in place before opening any positions. And as with any technical indicator, it's important to use the golden cross in conjunction with other indicators and forms of analysis before making a trading decision. To learn more about technical indicators such as the golden cross or to start trading, visit IG.com.